China was a massive disappointment for financial markets in 2024. And the question on the minds of investors as we get ready to turn the calendar, not surprisingly, is can they make things better as we go into 2025? That's what we're going to be trying to answer here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. We have a bit of economic data coming out of China in the beginning of next week, even as the markets get very little attention from most other quarters, as we have holiday closures in most major exchanges. But we will get a little bit of information out of China, and so this presents an opportunity to get a little bit of a pulse reading and see whether the world's second largest economy will finally get serious about trying to reboot. The data we're talking about, of course, the PMI numbers that are on the menu, they're going to be coming out early in the week next week. And what they are expected to show us here is, let us say, less than encouraging. These are the official figures from the National Bureau of Statistics and the China Federation for Logistics and Purchasing. So these are the government's figures. And as, of course, as ever with PMI numbers, the center line at 50 is neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what we see in the forecasts here is the expectation that standstill continues. All of these figures for December's edition of the data expected to be within a hair of that 50 center line. All of them a touch above, so 50.3 for manufacturing, 0.4 for services, 0.9 for the composite, but all of them very much within this anemic range that has persisted since basically the beginning of the year. China's economy has really gone very little distance to revival since the end of zero COVID restrictions. That's marked off right here in the tail end of 2022. There was a spike in economic activity, mainly in services, as we can see here, as the economy reopened and people started to move around and spend money again. But that has fizzled into standstill and hasn't really made any attempt to strike a more significant push higher. We have a competing set of PMI numbers from S&P Global and Caixin. This is a private sector estimate. And here, things look maybe a little bit more jumpy. And that's because we have this pop in manufacturing PMI in the November numbers. But so we can see this is still well within the range where things have anchored. It's just it appears to be based a little bit higher in the calculation than are the official figures. Either way you slice it, we are still stuck in range-bound conditions. And in any case, any kind of a pop in manufacturing here seems to be a temporary sort of development. Indeed, we saw that the recent set of export growth numbers had an analog pop here. And that, of course, is mainly reflective of what's going on manufacturing-wise. Those seem like they're parallel moves. And if we look at what business leaders that are being polled for these surveys are actually saying, and what seems to be coming out of the import-export numbers, is this vigor is a front-running of what companies fear could be the impact of trade war re-escalation. So if there is an expectation, as there is, that the incoming Trump administration is going to tighten sanctions and boost tariffs when it comes to China, and in various ways make barriers to trade between the U.S. and China higher, we understandably have businesses rushing before those steps are taken to get as much done, to buy as much stuff, to build as big of an inventory as possible before costs rise and barriers become more complicated to navigate. And so with that in mind, it's understandable that you have this burst in export growth, this burst in manufacturing activity, but that's hardly something you can hang your hat on as a lasting impetus for growth. And so when we look at what's actually setting up here, the picture being told in the official figures seems very likely to continue to give us generally anemic readings. And indeed, if we look at the way that Chinese economic data has performed relative to expectations, we can see some of the recent improvements, like those export numbers, have given us a rise in the City Economic Surprise Index for China, which tells us that economic data has improved a little bit relative to forecasts. But as we can see, once we got to the top of the range on this metric, we're already stumbling, and we've already started to go the other way, implying that analysts were quick to adjust their models in relative terms, but that ultimately we are likely to get results fairly close to forecasts. That would be essentially a reading of 0 on this index. And if we've started to roll over, then indeed we are expecting results hugging that 50 line will probably get endorsed when the realized numbers come out. And even if they are a bit higher than expected, it's probably not by much. So the story of standstill for China's economy probably continues and is reinforced by these figures. And this really captures its essence. For 6 consecutive quarters now, China has been in effectively economy-wide deflation. You see that here in the yellow, we have nominal GDP. That's the value of all goods and services produced in the economy plus the price component. When you add up the value, of course, the value of something can be greater demand for that thing, and also the price movement generated by that greater demand. Well, if you want to get at the value of the goods and services themselves without an inflationary overlay, you take that inflationary overlay out, and that's how we tend to look at economic growth for most economies, looking at real GDP, that is GDP adjusted for inflation. Well, what we have in China here is real GDP in the red is tracking above nominal GDP in the yellow now for 6 consecutive quarters. What that means is that growth minus inflation is bigger than growth with inflation, which of course implies that inflation is negative. If you take something, subtract from it inflation, and end up with a bigger number, then you're subtracting negative inflation. And we can see what that negative inflation looks like right here. Here's the spread. For 6 consecutive quarters, we have a deflationary coefficient on this price adjustment that's to the tune of between 1 and 1/2 of 1% of GDP growth. So needless to say, anything that's between 100 to 50 basis points of GDP growth is a staggering gap when you consider that it's the GDP of the world's second largest economy. That's your baseline. So China is effectively lacking of demand, which is what this implies. And the logic here is simple. If there is demand, then people compete to get the supply of goods that there is. And if everybody wants that supply, they start to compete on price and bid the price up. And whoever's willing to pay the higher price gets the supply. In the case of China, we have the opposite. There is no demand, and so prices are being slashed. It is as though the economy writ large has been relegated to the bargain bin. It is essentially on discount. Now, we haven't had an update of Chinese GDP numbers in a while, so you might say, well, this is perhaps lagged. But looking at consumer and wholesale, that is PPI, inflation numbers, which were just updated recently, we can see the same anemic story. As a matter of fact, CPI is actually edging lower in recent months, whereas PPI has been negative for a while and has stabilized only a bit recently after a run of cooling deeper into negative territory since mid-year. So this is very much an issue that continues. Now, for China's part, they've tried to stimulate, and most recently, a gathering of the Politburo, which is the 24 leading policymakers in Beijing that make the decisions that matter, Xi Jinping, the president, among them. They said that they're going to change fiscal policy stance for next year from the prudent stance, that's this, back to moderately loose. That gave markets all manner of support, at least sentiment-wise, because they figured, well, the last time that we were at moderately loose policy was in the midst of the 08-09 financial crisis. Obviously, this means China is ready to finally pull out all the stops to get the economy going. Well, not so fast. If we look at the history here, we can see China, despite sort of the rhetorical change and the label change, has already been cutting rates for quite a while. Moreover, they've introduced all manner of inducements beyond just cutting benchmark interest rates. They've lowered reserve requirement ratios for banks, allowing them to make more capital available to be lent out. They've spent money to prop up the stock market directly, thereby trying to put more capital in consumers' pockets. They've tried to improve the finances of local governments by letting them sell off assets and swap out debts and try to give them more spending capacity to boost demand. They've lowered mortgage rates to try to free up more money for consumers, to buy more real estate, and generally to deploy more capital. And the result has been exactly the opposite of what was desired. This is the Bloomberg Credit Impulse Index. It measures the share of new loans in GDP. What we can see here is this index, first of all, in level terms, the red line, is now at the weakest it's been since back here. The last time that there was a big sort of a clashing between the U.S. Trump administration, this time the first one, and the administration in Beijing. So we're looking at a tremendous drying up of credit despite all of this easing. Moreover, if we look at the way that this thing is moving in year-on-year terms, it is now shrinking at the fastest level since the aftermath of COVID, and that shrinking seems to be accelerating. So for all the easing and all the stimulus that China has tried to deploy, There is not more lending. There is not more capital deployed to boost the economy. We can see why. This is a chart using data from the PBOC, the People's Bank of China, from the Peterson Institute for International Economics. And what they show here is that households are hoarding cash. This is a chart of outstanding household deposits. And what we see here is they are massively, massively rising. That is to say, yes, there's all this cheap money. People are stacking it into their accounts, but they're not spending it. Moreover, a survey of households says that they prefer saving overwhelmingly relative to consumption and relative to investment by nearly 60%. And that, of course, tells us what we need to know here as far as why monetary stimulus isn't working. You can try to create inducements. You can try to tell people, well, take the cheap money. But if they don't then want to spend it, the stimulus from that money doesn't come. And the economy keeps standing still. Moreover, because it keeps standing still and because it's so anemic, foreign money is leaving. Certainly the threat of a more bitter trade war and perhaps an even tougher line with domestic firms, such as tech firms in particular, has spooked foreign capital over recent years. And we can see that foreign direct investment in China is now falling at a eye-watering speed, frankly, close to 30% year on year as of the latest data, and has been in double digits since the beginning of 2024. So domestic money is being stashed and not spent, and foreign capital is running for the exits. This is why when earlier in the year, China mentioned that maybe they would be a little bit more open to fiscal stimulus, to boosting demand, much like what the U.S. and the Western economies did during COVID, where rather than just reduce interest rates, governments went out there and spent money to make the economies run in the absence of private sector demand. When it seemed like maybe China would do that, there was a massive rally in Chinese stocks. This is ASHR, the ETF that tracks China's benchmark CSI 300 index, China's top listed shares in Shanghai and Shenzhen. But of course, that very quickly fizzled because none of it really came to be. Subsequent announcements from the Ministry of Finance, from the Politburo, from all manner of other policymakers, again, tinkered at the margins. But a big fiscal spending effort is yet to materialize. And so the move fizzled and has since stalled. And what we've seen here is subsequent talking about maybe fiscal stimulus, maybe finally there's a readiness. Well, markets have become circumspect now. They're just not buying it. And of course, this is a huge issue for the broader markets going into next year, because if we look at the makeup of global GDP, we find that just 3 economies account for 58% of global demand, of which China is the second largest. Moreover, the rest of the world, the 42% that isn't in the top 3 economies, they're mainly vendors to the former 3 and need export demand from the former 3 to have growth of their own. So actually, the impact of these 3 is even greater than their 58% suggests. And while the U.S. has been booming, obviously these are very different looking PMI numbers, accelerating sharply, in particular for the U.S. service sector, the situation in Europe is anemic. And of course, we've just seen that the situation in China is very much the same. Moreover, in the US, all of this is being powered by services, and US services demand is mainly for the wares of domestic companies. So this US strength has not spilled over. Most US services demand is directed at American firms. So despite this strength in the world's largest economy, the global situation has been much soggier. In fact, we are basically looking at an attempt at acceleration in the first half of this year, having fizzled and given us a return back to where we started for global PMI numbers. And that's certainly not because the US has slowed down. It's because the situation in the Eurozone and, of course, in China has broadly disappointed. Where China stands out for particular demerit is because they've not had growth rebound and because they did not have the inflationary uptick that happened in the wake of aggressive fiscal stimulus in the US and Europe. Their debt situation has only gotten worse since the pandemic. We see here the global total for debt, and when we look at what happened in the US, in the advanced economies, and even in emerging markets excluding China, giant increase in debt during the pandemic, of course, as everybody spends to keep their economies afloat. But then the inflationary spike the world over, and of course in the advanced economies in the US, that creates a situation where the inflation starts to eat away at the debt and make it more affordable. These are changes in public and private debt as a percentage of GDP. In 2021, 22, 23, for the advanced economies, for the US, that actually falls. Not for China. Because China hasn't been able to reboot its economy and restart inflation, and because it is in a deflationary spiral, its debt burden is actually increasing in 2022, in 2023, and almost certainly again when we get the updated numbers for 2024. So not only is there a problem with demand, but more and more of the government's outlays are being sucked up by expensive debt outlays. So as we look at what China means for the markets next year, the simple answer is that it does nothing to help global growth. And so if the US were to stumble, then China isn't a safety net preventing the world from sliding into global recession. But the next deeper step is that China is now a huge credit risk, because through all of its slow performance, it has actually become less credit stable and is losing the ability to deliver the kind of fiscal stimulus it needs as capital from abroad leaves, as capital domestically doesn't want to be deployed, but as the need for capital to service both debts and a fiscal restart effort make a greater demand on government finances. In fact, the only thing China that seems to have managed is buying more gold for its reserve account since pausing here earlier in the year. And so perhaps the only asset able to benefit is bullion. But anything growth related might increasingly find China to be not just the absence of assistance, but a mounting headwind as we go into next year. And that is macro money for today and for this week. We'll be back on Monday at the start of next week before another break for the New Year's holiday. As ever, we are here right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what it might mean. We come back to a full Monday through Thursday schedule, first week of January 2025. I'll be commenting in the meantime on the platforms where I can be found at Ilya Spivak, the one formerly known as Twitter, as well as now on Blue Sky. Whatever holidays you may be celebrating, I hope you enjoy those. Macro Money's back next week. Happy trading.